What's your basis in IBM?
What's the basis on it?
Yep, for you.
I think it was your cost basis?
The cost basis, yeah, the cost basis is probably a little less than 170.
A little less than 170. And are you, a lot of shareholders wrote in trying to understand where, how you feel about IBM these days, both positively or perhaps negatively.
Yeah, well, we feel fine or we wouldn't own it. And we've never sold a share of IBM. Periodically, we buy a little more, although we're up fairly close to 10%. So we have not been an aggressive buyer, but we have been a buyer, and we have never sold a share. And it's a company that has lots of tough competitors. One of them may show up here pretty soon at the studio, and it will always have competitors. We see them doing some interesting things, but the competitors are doing interesting things too. Overall, we like it, and I think I can safely say we would be much more likely to buy more in the next 12 or 24 months than we would be to sell shares. But we'll make that call as time goes along.
Warren, let's talk about shares of Yahoo, or the company situation, I should say, Yahoo. We had Sue Decker, who's a Berkshire board member, join us on Friday and talk a little bit about how she sees things at Yahoo. There's just some news out over the weekend about Marissa Mayer having a $55 million severance package, and that package will kick in if there's a change in control at the company. You've been kind of following this remotely. I wouldn't ask you too much about what you think about the digital strategies. I know that's not really your area of expertise, but what have you thought watching things play out?
Well, obviously they deteriorated significantly. They did a terrific job with our annual meeting. I mean, I've been hearing nothing but positive fallback, on that. Andy Serwer was in charge of it, and they couldn't have done a better job. So I feel very good about that. But their business has continuously slipped, and they made a lot of acquisitions in the last couple of years, and clearly they, it has not turned around the company. I think they've said that they expect revenue to be down in 2016 again, and it's something has to change there, obviously. I think these severance numbers just generally throughout American industry are a little crazy. I mean, when a laid-off employee gets, 2 weeks for every year of service or something like that, and somebody gets 8 figures, I think things get a little mixed up. But I've seen it. That just continues to build. Almost anything in executive compensation, whatever was done last year for people generally becomes the base for an increase the following year. I mean, the American CEOs and generally executives and board members, there's just a ratcheting effect that goes on. And somebody says, I've seen a severance package that is X, and then the next person says, well, I want one that's 1.5 times X. And when they're signing people up, they don't pay much attention to it. If I were the American shareholder, I think I would get a little irritated with some of these goodbye kisses.
Hey, Joe, you have another question?
Yeah, on a different subject, back to thinking about the current environment, Warren. And when you are one of the richest countries around, I guess you've got to expect that your trade imbalance, your consumers are able to afford so much more that you're never going to have a trade surplus, really. But then again, on both sides of the aisle, it makes political hay to talk about we're getting the raw end of the deal, that we're not, the money's moving out, and it's not fair that we're not getting more business, domestically from that. I'm just wondering what you think about. I mean, by definition, we're never going to have trade surpluses most places. But is there a way to do trade deals that are more advantageous to American workers? I mean, there's a reason why everybody's so disillusioned.
Yeah, we've had trade surpluses if you go back a long way while we were the most prosperous country. But it's kind of interesting. Our total exports were 5% of GDP, I believe, in 1970. And now they're about 12%. So we've gotten really pretty good at selling things to the rest of the world. a huge dollars amount and an increasing percentage amount from many years ago. But we've also swung more to imports. And of course, for a long while, a very good bit of that was oil. You know, in theory, it's very nice when you can be a net importer, because you hand people little pieces of paper and they hand you underwear and socks and shoes and all those sorts of things. And unfortunately, the balance of monetary assets held abroad then grows. And right now, the world has about 7 to 8 trillion more of our securities than we have of theirs. I don't think that in itself is a dangerous number, but I don't like that number to go up, or certainly go up as a percentage of GDP. American industry has actually been pretty good, though, on exporting. 12% of GDP is not a bad figure when you look at the record historically. And of course, right now the trade imbalance is, you know, $500 billion a year, which is a 3% factor or thereabouts on GDP, and that's come down somewhat, helped by oil. But of course, if oil goes back up, we got another problem. I would rather see something closer to a balance.
Hey CNBC fans, thanks for checking out our YouTube channel. Here you're going to find videos packed with all of the information that you need to be smarter about your finances. You can subscribe by clicking right here, and click on all the videos around me or the eye right here to watch the latest from CNBC. Thanks for watching.